A lot of business owners believe that if revenue is going up, the business must be healthy. More sales, more customers, more activity feels like progress, but there's a quiet trap that destroys a lot of growing businesses, and most owners don't realize they're in it until the cash is already gone. It's what I call the gross profit trap. This is where revenue keeps increasing, but your cash flow keeps going tighter. You're busier than ever, but somehow there's less money available. Payroll feels heavier, bills feel closer, and the business that looks successful from the outside starts feeling stressful on the inside. What's happening is simple. Revenue is growing, but gross profit isn't keeping up. And gross profit is what actually pays for the business. Let me explain what that means in plain terms. Gross profit is what's left after the direct cost of delivering your product or service. If you sell something for $1,000 and it costs you $600 to deliver it, your gross profit is $400. That's $400 that has to pay for everything else. Your marketing, your software, your rent, your taxes, your owner pay, and hopefully actual profit. Now, here's where the trap shows up. A lot of businesses scale revenue by cutting prices, adding labor, or over-servicing clients. They think they're growing, but what they're really doing is shrinking their margin while increasing their workload. More revenue, less breathing room. I see this constantly with service businesses. A company lands a new contract and celebrates because the deal is big, but the owner never actually calculates the real cost to deliver it. More staff hours, more project management, more revisions, more customer support. The revenue numbers look impressive, but the margin quietly gets thinner. And when that happens at scale, the business becomes fragile. You start feeling you need more sales just to stay in the same place. You start chasing revenue to solve problems that revenue actually created. This is the gross profit trap, and it's one of the biggest reasons growing businesses suddenly hit a cash flow wall. The owner thinks the answer is more marketing, more sales, more leads, but the real issue is the business is leaking profit at the delivery level. So the first mental shift every entrepreneur has to make is this: revenue is vanity, gross profit is oxygen. Revenue tells you activity, gross profit tells you whether the business can breathe. A healthy business protects gross profit first. That means understanding three things extremely clearly. First, the true cost of delivery, not the guess, not the estimate, the real number. If a project takes 22 hours instead of the planned 15, that matters. If a team member has to redo work 3 times, that matters. If onboarding client eats up 2 weeks of staff time, that matters. Most businesses never measure this closely enough. They price based on optimism. Then they deliver based on reality. And reality always costs more. Second, businesses need to watch margin erosion as they grow. Growth induces complexity. More people, more communication, more coordination, more management layers. Every one of these things slowly eats margin. And if pricing doesn't adjust with that complexity, profitability shrinks even while revenue climbs. That's the moment when owners start saying things like, we're doing more business than ever, but there's never any money left. It's not a mystery, it's math. The third piece is learning to lead outcomes instead of managing activity. A lot of businesses lose gross profit because the team is busy, but not efficient. Tasks are happening, but outcomes are unclear. So projects drag, revisions pile up, clients get overserviced, and labor costs quietly balloon. When a business starts managing outcomes instead of tasks, something interesting happens. Delivery becomes tighter, expectations become clear, time waste drops, and gross profit improves without increasing revenue at all. That's a huge shift because the healthiest businesses don't chase revenue first. They protect profitable delivery first. Then they scale it. This is also why so many founders feel burnt out during a growth phase. They're trying to carry the stress of the business that looks successful but doesn't feel stable. Cash flow pressure creates decision pressure, and decision pressure creates exhaustion. But when the gross profit structure is healthy, the business behaves very differently. Revenue growth actually creates breathing room. Cash accumulates. Hiring becomes strategic instead of reactive, and the owner stops feeling like the business is one bad month away from panic. That's the difference between scaling revenue and scaling a healthy business. Revenue scaling alone is dangerous. Margin-aware scaling builds stability. So if revenue's been growing, but the business feels tighter instead of stronger, step back and ask one simple question. Where is our gross profit actually going? Not the theory, the real numbers, because somewhere between the sale and the delivery, margin is being consumed, and once you find that leak, everything changes. Suddenly, growth stops feeling stressful, and the business finally starts behaving like the success it appears to be. Now, if this gives you something to think about, save it and come back to when you look at your numbers this week. Sometimes the biggest breakthrough in a business isn't more sales. It's finally understanding where the profit disappears.